Good morning. Here comes my second lecture on chapter 4. We left off on page 122 yesterday discussing transactions and how we enter transactions. Now, let's get back to something that I had drawn here, if I can find it. There it is. This is the worksheet we started with yesterday. And just to repeat what I said, here we see the almighty equation, okay? That is status of a company at any point in time. Doesn't matter how many assets and liabilities we have, the real key number is the equity, okay? Because that measures your wealth directly. How does equity increase year after year after year? By us, we, the company, engaging in profit-making activities. Down here, what we're going to do is create a bunch of these accounts, temporary accounts, okay? They're only going to exist for a year. And we're going to use those accounts to add up all of our profit-making activity. The sum of those four numbers will equal our net income. Forget about taxes. We'll deal with taxes later. Okay? Now, if these are called temporary accounts, I'll give you three guesses what we call these. Those, of course, are called permanent accounts. These are the ones that will survive year after year after year. And if we're doing things well, that equity number that I highlighted in red will just keep getting bigger and bigger and bigger, and you get wealthier. Your company grows. So, for ease of measuring, every time we do a profit-making activity, we don't adjust equity. We've got to adjust all numbers. But we're going to adjust these temporary accounts instead whenever we generate revenues, expenses, gains, and losses. Once a year, we're going to take those four accounts. They all will add up and combine to form our profit or income, as I mentioned before. We're going to transfer the totals of those accounts up here to equity. Okay? And when we do that, we always have to maintain balance, right? We're going to zero these out. And then we start a whole different year. So we start every single year with these temporary accounts at zero. At the end of the year, we take what's ever in them, it equals our income, we put it up here to equity, and then the whole game begins again. Okay? So we haven't touched any activity yet in the examples I've given you through page 122, with one exception. We paid an employee, and that was an expense, right? But instead of sticking that in equity, the slides can be misleading about that, we're going to put it instead in one of these temporary accounts. So when you deal with these temporary accounts, friends, I want you to remember this. We love revenues. Revenues increase, equity increases. They behave just like equity. So when revenues increase, okay, they will increase our equity. That's making us richer, okay? So I'm just going to make a note that this increases our equity. That's a good thing. Anything that can increase our equity is our friend. Expenses, what can I say? They're the opposite, the polar opposite. They're the bad part about this income statement that we're producing here, because it means you've got to spend some money. You've got to pay somebody, like we paid our employee, like you buy supplies, like you pay your electric bill. Every expense has to, in some direct or indirect way, support revenues. All right? Expenses must be controlled, minimized, eliminated, because they're taking away from your wealth. All right? But without expenses, you're not going to have any revenues. So a cost, an expense that supports revenue, okay, is there for that very reason, to support revenue, but it is taking away from our equity. So whenever you see expenses increase, that means our equity is decreasing. Okay? Now, the same thing is going to happen with gains and losses, so I'm just going to cheat and copy this for you and stick that right there. Okay? Gains, even though they're extraordinary, increase our equity because money's coming into us. We made out. Like if you sell a truck that you bought for $10,000 and you manage to sell it for $12,000, you think you're not in the business of selling trucks, though. Okay? That's incidental. It's extraordinary. Well, we'd call that a gain. Man, you made out, so it's definitely a gain. If, on the other hand, that $10,000 truck, the best you could do is to sell it for $8,000, you're going to have to take a loss. It decreases equity. So at the end of the year, we're going to add all of these up, and it should equal our bottom line, our profit, our income. We're going to transfer that up here to equity. This will now balance. The temporary accounts have been set to zero, and now we start all over again. Okay, now having said that, when we left off, let me just save this for us. Let's get back to our slides. Now again, the only expense that we've encountered so far is paying one of our employees a couple of pages ago for $300. But now we're in business to sell stuff, to generate activity. So this is where we left off. Now remember, you're not going to buy some inventory for $2,000 and sell it for $2,000 or less. No, you want to make a profit, right? So you're going to buy something for $2,000, and in this case, the company makes a sale of that inventory, and they manage to get $5,000 for it. Now, please remember, because of the type of inventory system, more on that later, that this company is using, whenever they make a sale, it requires not one transaction, but two. I referred to these yesterday as entries. So instead of making one, like we've done up until now, one thing increases, another thing decreases, that type of thing. Now what we're going to do is actually record two of these transaction entries. One to generate the sale, and one to show the inventory leaving us because someone bought it. We don't have title to it anymore. And you've got to get it off the books. But there's another reason. How much gross margin, gross profit are you going to make on this transaction? $5,000? No, you're not making $5,000. You're selling it for $5,000, but you're making $3,000 because the inventory has become an expense. As long as you owned it and hadn't sold it yet, it was an asset. But now, as soon as it goes to generate revenue, it generated revenue, right? You bought it, you sold it. It now has to be transferred to expense. And we call that a cost of goods sold. Okay, so there you have your two transactions, friends. Break it down. You're selling it to a customer for $5,000 on credit. That's all you need to know. You know, therefore, that your accounts receivable, the money people owe you but haven't paid you yet, goes up $5,000 at the selling price. Okay? What else goes up? Sales. Now, they've put it under equity, but they've also put in parens sales. That is a revenue account. That's a temporary account. The authors are reminding you that sooner or later, all sales expenses and gains and losses will end up increasing your equity. They simply haven't done so yet. We'll do that at the end of the year. Right now, we're still using the temporary accounts. The second transaction, that $2,000 has to follow the revenue. It's done its job. You bought the inventory. The second entry gets the inventory off your books. It's got to go. Two of you can't own it at once, right? And secondly, we have to get that $2,000 matched against the sale it supports. Okay? So the $2,000 follows the $5,000. Now you've got an equity item, $5,000 revenue, and you've got a matching expense of $2,000. So right now your gross profit in this transaction is $3,000, as it should be. Okay? And I used a key word there, matching. Accountants use, the accrual system uses the matching principle. That means that the expenses have got to follow the sale that they help to generate. Sometimes it's direct, like this. Other times it's indirect, like paying your electric bill or paying an employee who sweeps the place. Those are still expenses, and you wouldn't have stuff to sell without all of these indirect people. So please remember, cost has to follow the revenue that it helped to generate. Number one. Number two, the inventory has got to come off your books. Assets have then decreased by $2,000, and an expense has increased by $2,000. Remember, we don't like expenses increasing because that means we just had to spend some money on something, and we'd rather not do that if we can help it. Fair enough? Study this one carefully for me. All right. As of right now, this company, in their temporary accounts that measure income activity, have gross profit defined as sales revenues minus cost of goods sold of $3,000. The $5,000 sale and the $2,000 cost of goods sold, the expense that followed it. Okay. So far, everything is stated properly. Life is good. Okay. The authors take a moment to mention that every transaction consists of cause and effect. Okay, you're going to have two accounts being affected at a minimum. Why? Well, because then otherwise your master accounting equation wouldn't equal. We've got to maintain that that holiness, for lack of a better word, of the equal sign. So you can have a minimum of two accounts being affected. Now, once again, what's an account? We've discussed many of them. Cash, accounts receivable, inventory, those are assets. Accounts payable, notes payable, those are liabilities. Okay. Retained earnings, common stock, those are equity accounts. There can be many, many, many more. Those are just a couple of examples. All right. Revenues will be mostly sales. You could have it come from other places too, depending on how many things your company does. And expenses. Oh my goodness, there are dozens of expenses. Okay. Cost of goods sold, payroll, maintenance, electricity, HVAC, interest, accounting fees, legal fees, rent. Okay. All of those are examples of expenses. They exist to support revenues, although we'd be happier without them. Okay? When they talk about cause and effect, that's precisely what they mean. Minimum of 2 counts have to be affected to maintain that equal sign balance, but it can be more than 2, as long as they all equal out, and you can add them together so that one equals the other. Okay? But it can never be less than 2. Bear with me, please. Okay, now, what if you recorded an expense previously, okay? Previously you've paid an expense. If a company pays $700 for insurance and it relates to the past few months, you got to think about this one now. We've expended the money, but we haven't paid for it yet. Cash has not changed hands. It's about to. But as the expense was incurred over the last couple of months, can we just forget about it? No, a proper method of accounting under this accrual method is any expense can be separated from its cash effect. So you do the expense in one period, and later on when you do have to write a check, you do the cash then. So if you're recording the expense before you've paid it, how do you do that? Well, what you would do is as you go, you would be increasing your insurance expense every month and recording a liability, because you know that insurance bill will get here sooner or later. Okay? But you can't wait until you pay it to show the expense. Otherwise, you won't be matching. If you use up insurance in July, you've got to record it in July, even if you don't pay it until September or October. Now, that's what's happening here. So we're assuming, because of what I just told you, and the authors mentioned this as well, right around page, where am I? 123, okay, that insurance expense has been going up each month as you expend it, and because you weren't writing any checks, where else do you affect this entry? It happens under insurance payable. You're increasing a liability a little bit at a time as you go, okay? So now one day the insurance bill arrives, it's time for you to write a check. Well, okay, you know cash is going to decrease. What else has to happen? Will you increase expenses? No. You've already recorded those expenses, ladies and gentlemen. You can't record an expense twice. Okay, that would misstate your books. Your company's information would be totally out of control. No, you've recorded the expense, but you've been showing a liability, a debt, to your insurance company, increasing month by month as you go. Now you got to write a check. So you reduce cash and you reduce the liability, because once you pay a debt, you don't owe it anymore. It goes away. It's extinguished. You all see that? Okay, think about that. You only pay a debt once, friends. So now insurance payable has been wiped out. The expense has been put in the proper months, and your company's been paid. Your insurance company, I should specify. Okay? That is the accrual system. Separation of revenues and expenses, most times, many times, from the actual cash inflow or outflow. We separate them and handle them differently. Fair enough? All right, here's an example of, I told you, minimum of 2 transaction items happening, but it can be more than 2. In this case, we're going to buy a truck. And we don't like to pay cash if we can help it. I'd rather pay someone later. I'd rather buy it from you today and pay you later. That's good business. And cash, really, you want to hang on to your cash, especially in a young company, because that will make the difference between failure and survival if there's a business downturn. Cash will keep you alive. So now this company has bought a truck for 40 grand. How did they do it? Well, you know right away, go no further. A company acquires a truck for 40,000. That means that all of a sudden, An asset has gone up by 40,000. They've got a truck they didn't have before. So we know something's got to go up by 40 grand. All right, then you read on. How? Well, we paid 10 grand in cash. Stop right there. Okay, we know that cash, another asset, has got to come down. Okay. Finally, all right, we got a truck for 40. We paid cash of 10. Where does the other 30,000 go? Well, you signed a note. A note payable, that's a debt, that's a liability. And you'll pay that note off as you agreed with the seller later on, maybe in pieces, month by month, maybe in one lump sum in 6 months. That's all up to how you negotiate with this lender. Okay? But that's a valid debt. You owe this money to them. They've got a claim against you. But you're not going to make the note out for 40, are you? No, you already paid them 10. So for that $40,000 truck, you pay 10 in cash, and you promise to pay the rest later, 30,000. Balance is maintained. Look at that equation. One asset went up by 40, another asset came down by 10. The left side of that equation, therefore, has increased by a net of 30. The other side of the equation shows the increase in liabilities, 30 on one side, 30 on the other. Now, friends, I've seen entries made, especially if you do something complicated like one company buying another, that could have 100 increases and decreases in one transaction. Okay? But we're going to keep it nice and real and simple here. Okay? All right, what else do we have here? Capital contribution. Now, the equity section of our equation, I've already made it clear, goes up by net income. All the temporary accounts, that's where we gather all our revenues and expenses, and once in a while, once a year to be exact, we take them, wipe them all out, and transfer that income total to equity. So your equity section goes up because of those earnings, but it can go up another way too. And that is if the owner, the shareholders, infuse money into the company. The company can choose to sell more stock, or a sole owner can inject more money into her company, but that's known as a capital contribution. It's not revenue, it's not expense, okay? It's an increase in the equity because the owner or owners or shareholders, whoever it is, has infused money by buying capital stock. That's a capital contribution. When that happens, in this case, a company issues ownership shares to a new stockholder for 19 grand in cash. What has happened here? Well, 19,000 in cash has been infused into the company. There it is, an asset, cash, goes up. What happens on the other side? Well, that's equity money. A shareholder has just gained a bigger equity position in his or her company. Okay? So equity goes up, an increase of 19 grand over there. That has nothing to do with making profits, okay? It's simply more wealth being injected into a company. The company could have gone out and borrowed it and increased liabilities, but they didn't. Instead, they went to the owners, the shareholders, and said, instead of our borrowing the money, we need 19 grand in cash. You buy 19 grand more in stock. Your wealth has just increased. Okay? Remember, equity is the measure of wealth. We go on. Okay, now, back in an earlier transaction, we sold stuff. We sold our inventory for $5,000 at its selling price. Remember, we bought it for $2, but we sold it for $5, right? And we sold it on credit. So instead of cash going up, accounts receivable went up. It's still an asset, and it's almost as good as cash, but it's not. We expect to collect it later. And guess what, guys? There it is. We just did. So we're going to collect cash that the customer owes us for $5,000. We know, therefore, that cash goes up. What else goes up? Sales revenues? No. I told you a minute ago, you don't record an expense twice. It's already on your books. You made the sale. That's where we separate the timing of revenues from the flow of cash. Okay? So, don't touch revenue. We already recorded the revenue. You can't record that $5,000 again. So what do? Do you still have an account receivable? No, you don't. As soon as you collect money, the account receivable is dead. You can't collect it again. Just like you won't pay a debt twice, you can't collect a receivable twice. It dies. So you're swapping one asset for another. The receivable goes away because it's been honored, it's been paid, and cash went up. So one asset goes down, one goes up, balance is maintained. Okay, it works the same way for payment of an earlier purchase. That inventory that we sold, we had bought it on credit. We didn't pay cash for it. Okay, we put it on our books as inventory, and we said, ooh, what else do we affect? Well, we're going to pay it later. Well, that's an account payable. That's a liability. So now we're paying off that obligation to whoever sold us that stuff. So cash comes down by $2,000 because we're writing a check, and accounts payable comes down by $2,000 because you've now extinguished it by paying it. We don't pay our debts twice. I hope you're all getting the idea of how assets, liabilities, and equity work. Remember, we're busting out a bunch of miniature little temporary equity accounts just to make life easier. Okay? We'll show you the actual mechanics of how this works in a little while. Okay, now we're paying rent in advance. Now remember, we match expenses to the proper period. And the key phrase is here, payment of rent in advance. That means that the landlord wants her check before we've occupied the space. So we're going to write her a check on February 1st for the month of February. But we haven't used it up. Okay, I don't care. You can't touch space. I suppose you could touch the building. But the space you rented, that is going to be used up in its own way. So it hasn't been used up yet. You're paying it in advance. So you can't call it an expense until you use it up. Until you use it up, therefore, what is it? It's an asset. Okay? It's called prepaid rent, and it is an asset. Something that has not expired yet. As you use it up, it's going to become an expense, but you simply haven't used it yet. So that's kind of similar to what we did before with paying off an obligation. But this time, you're setting up a different asset. So since you're writing a check to your landlord, cash comes down by $4,000. Where do you put the other part of it? In prepaid rent, another type of asset. And later on, as you do occupy that building, therefore using up your prepayment, you'll gradually transfer, see, it's for 4 months. So month by month, you'll transfer a piece, a piece, a piece, and a piece from here, the asset, to equity. Okay? I should point up here. This is where you guys all see them up here. Okay? So on your file left, you've got prepaid rent. Over the next 4 months, as you occupy the building and use it up, it's not an asset anymore. Okay? You're going to take $1,000 out, and it's going to go to expense. Next month, another $1,000 expense, another $1,000, another $1,000. After 4 months, the entire prepaid rent has been reclassified to expense. Okay? Very good. I told you that this system was created, by now it's over 500 years ago. And I erroneously mentioned that it was the 16th century. Actually, it was the end of the 15th century, as you can see here, by an Italian monk, of all people. And he put together such a slick system known as double entry bookkeeping that no one's ever come up with anything better. Right now, a bookkeeper will enter transactions into a computer. He doesn't have to know what the computer is doing, okay? But as I said in class, the accountant doesn't have that luxury. I don't care how fancy the computer is. The accountant has to know what that computer is doing. And that's everything I just showed you in a simple example. Why? Well, because the accountant many times has to be a detective. And she has to go investigate and see what happened and know where to find it in that computer. And that means even though the bookkeeper doesn't have to encumber himself with that level of detail, the accountant does. Having the computer as a tool is simply one of speed and efficiency, but the accountant still has to know what's going on in that machine's guts. Okay? All right, very good. Ladies and gentlemen, I think it's time for us to end today's lecture there. I will cut off here. I am on page, hold on please. I'm on page 129, so this lecture will take us from page 122 to page 129. Stand by for more. Please keep up on your reading. Always be checking my courses, and above all, friends, do not procrastinate, okay? Make sure you keep up, because we don't want you to stop falling behind. Really, we've just barely got over a month to go, so we're going to be moving at a pretty good clip, so please make sure you're doing your reading, okay? That's all we have for today, so I'm going to wish you Very safe weekend, stay well, and we'll talk to you again soon. Bye-bye.